Since our last update at the end of 2016, investment markets have been played out against a backdrop of dramatic political headlines. Donald Trump's inauguration and executive orders, Theresa May's Brexit speech, and the ruling that Parliament was required to vote on triggering Article 50 to leave the European Union. But despite the political hullabaloo, markets globally have been generally positive, with American stocks leading the way. Since the election last November, they're on their best winning streak in 25 years. While share markets elsewhere have not been quite as strong, they are all up since the US election. And Australia has booked an 11% rise since the 8th of November alone. Global bonds produced a negative return, driven by a sell-off in the United Kingdom and Europe, where 10-year bond yields rose in January. But why? In Europe, it was driven by the threat of reduced asset purchases by the European Central Bank, supported by ongoing economic growth. In the UK, it was due to the surprisingly robust economic response to the Brexit vote and increased inflation, which was partly driven by the depreciation of the British pound. Let's have a closer look at the USA now. The US Federal Reserve, after increasing interest rates last December, decided in February to keep rates unchanged. Nonetheless, it has indicated that further rate hikes over the course of 2017 are likely. The US economy posted somewhat disappointing growth during the fourth quarter of 2016, but survey results indicate improved growth in early 2017. These sentiments are driven by President Trump's stated policy objectives of increased investment in infrastructure, the loosening of financial market controls which will make credit easier to obtain, significant tax cuts, and the building up of the military. Economic data coming out of the US in February suggests that general sentiment is supportive of Trump's stimulatory and expansionary agenda. January retail sales were higher than expected. Housing approvals remain firm. New car purchases are trending positive. The United States Index of Small Business Optimism rose again in January to its highest level since December 2004. Manufacturing has also recorded a significant turnaround. The Philadelphia Federal Reserve Bank Manufacturing Survey has just hit its highest level since 1984. President Trump has inherited a strong economy. His challenge will be to maintain the momentum. Turning our focus now to China. In 2016, China faced four challenges. Firstly, a slowing economy, share and property market volatility, capital outflows, and finally, depreciation of the currency. As a result, Chinese policy has refocused on supporting its economy and investment markets. Economic growth in the latter part of 2016 was 6.7%, with a target for 2017 of 6.5% to 7%. The quality of economic data has improved recently. Political changes could bring the emphasis back onto long-term economic and political reforms as the first 5 years of President Xi Jinping draw to a close. The 19th National Congress of the Chinese Communist Party will be held in the autumn of 2017, and far-reaching changes in the makeup of the top leadership of the party are anticipated. So it's expected that 2017 will be steady as she goes for China, with minimal surprises anticipated in economic outcomes. Here in Australia, the resources sector has continued to rally strongly, diverging from the broader share market, which declined in January but bounced in February. The resources sector, driven by recovering commodity prices, increased by more than 5% in January and has gained 65% over the last 12 months. The Australian dollar has appreciated against all major foreign currencies in 2017, driven by the rally in commodity prices, which has increased Australia's terms of trade. Despite positive signs in the US, China, and here in Australia, given the major forces shifting globally, the investment outlook remains uncertain in a year of continuing political upheaval in the US and Europe in particular. With these tectonic shifts and other volatilities firmly in mind, we will continue to structure our portfolios to better absorb volatility, preserve your capital to the degree to which market risk reasonably allows, and maintain our focus on growing your wealth.